A few months ago, Tom Lee, one of Wall Street's most respected analysts, quietly became the chairman of the largest corporate Ethereum holder on the planet. Not Bitcoin, Ethereum. And in this conversation with Cathie Wood, he said something that should stop every Bitcoin maxi cult. He said Ethereum could do to Bitcoin exactly what Wall Street did to gold in 1971. If he's right, and the historical parallel is uncomfortably precise, then the next 5 years in crypto are going to look nothing like the last 5. Let's get into it. Lee has a very specific thesis for why the institutional money couldn't come into Ethereum before 2025, and why the door that just opened may never close again. There's a stat he drops in this clip that I genuinely had to pause and rewind. It involves Tether, JP Morgan, and the most profitable business model per employee in the history of global finance. Here's what he said.
Why 2025 for Ethereum? The Bitcoin and MicroStrategy's 2020 pivot made a lot of sense because Bitcoin was only 11,000 at that time. And he represented the sole way to get exposure to Bitcoin for any institutional equity manager.
Well, except for GBTC, right? Because we were in GBTC.
Yes, but for a firm like Capital Research or T. Rowe, they're unable to buy a closed-end fund or an ETF or directly own crypto because their mandates require them to own a corporate equity.
I see.
So Overstock was probably the only way someone could buy Bitcoin in the past. And then MicroStrategy came along. So MicroStrategy is almost 2.0 as Bitcoin Treasury. What he's done successfully, of course, is really to upscale it so rapidly because he went from having $2 of Bitcoin per share to over $250 per Bitcoin share, per MicroStrategy share today. So he has created enormous shareholder returns because the security business, of course, has continued to really muddle along at basically zero growth. In Ethereum, I think the moment is really this year because this is the year that Wall Street and governmental regulations became friendly to think about rebuilding on the blockchain. And part one, of course, was the stablecoins, and stablecoins have really been the breakout hit in crypto. We coined it as the ChatGPT moment for crypto because it has become a breakout product and it has created two enormous companies, one being Circle, which I know ARK was an anchor investor in the IPO, and the other is Tether. Tether today is raising money at a $500 billion valuation and roughly 300 employees. That's about $1.7 billion of market value per employee.
Yeah, we featured that. We featured that, Tom, in last year's Big Ideas because we said, oh my goodness, at the time it had 180 employees. We said, there's never been anything like this before. Right.
Yeah.
So you're right.
And so JP Morgan, who just $869 billion, has 313,000 employees for $2.8 million of value per employee. Tether is showing you a crypto native bank is fundamentally vastly more profitable. And that's what I think is happening on smart contract blockchains that are neutral like Ethereum and Solana. But it really only could have started in 2025.
300 employees, $500 billion valuation. That is $1.7 billion of market value per person at Tether. JP Morgan, the most powerful bank in the world, has 330,000 employees and generates about $2.8 million per employee. Let that ratio sink in for a second. Tether is not just more efficient than JP Morgan, it is operating at a fundamentally different level of productivity that the traditional banking model cannot compete with. Not now, not ever. Because the cost structure of a crypto-native financial institution is not just lower, it's a completely different species. And here's Lee's core argument. Stablecoins were the proof of concept, the ChatGPT moment that showed the world this works at scale. But stablecoins are just dollars on a blockchain. What comes next is everything else. Stocks, real estate, bonds, commodities, every financial asset that exists today, moving onto the blockchain. And the chain that wins that migration, that is the most valuable piece of infrastructure on Earth. Lee thinks that chain is Ethereum, and he thinks it could make Ethereum worth more than Bitcoin. Here's the exact argument. I want to be precise about what Tom Lee is actually saying here, because it's easy to hear Ethereum flips Bitcoin and dismiss it as altcoin cope. But Lee is not making a crypto argument, he's making a history argument. He's pointing to a specific moment in 1971 when Nixon took the US off the gold standard and showing you what happened to the relative value of gold versus equities over the next 50 years. Gold was the store of value, the safe haven, the thing everyone agreed was money. And then Wall Street built an entire financial system on top of a fiat dollar, and gold went from dominating global reserves to representing just 5% of all available assets. Lee's thesis is that Bitcoin is digital gold, and Ethereum is the new Wall Street. If the same pattern plays out again, and he thinks the 2025 regulatory shift is the exact equivalent of the 1971 moment, then we are at the beginning of the biggest reallocation of financial value in modern history. Here are his exact words, including the price targets.
I'd love to hear your thoughts on why ETH, or the ecosystem, will surpass Bitcoin.
Okay. Well, if I could rewind a little bit to 1971, in our chairman's message last month, we addressed how gold versus Wall Street grew post-1971. So 1971 was when Nixon formally withdrew the U.S. from the gold standard. The immediate beneficiary was there was demand and a market to own gold. And so people would say that was your, first implication. But what we wrote about and talked about in our message was that in 1971, the dollar became fully synthetic because it was no longer backed by anything. And so there was risk that the world would go off the dollar standard. So in stepped Wall Street to create products to propagate the future of Wall Street, including, and we listed, I think, 14 products that emerged over the next decade, from money market funds to credit to mortgage-backed securities to futures, etc. And dollar dominance by the end of that period went from 27% of GDP terms, but to 57% of central bank reserves and 80% of financial transaction quotes. So Wall Street created products that made the dollar dominant, and the market cap of equities today is 40 trillion compared to 2 trillion for gold. So in other words, gold is 5% of all available assets. And so in 2025, we think everything is now becoming synthetic or tokenized, sorry, not synthetic. So as we move not just dollars onto the blockchain, which is stable coins, but we'll move stocks and real estate, dollar dominance is going to be the opportunity of Ethereum. So digital gold is Bitcoin. And so in that world, we believe Ethereum could flip Bitcoin, similar to how Wall Street and equities flipped gold post 71. Now, that is just our working theory, because I am still a Bitcoin bull. So I'm very bullish on Bitcoin, and I believe your targets for Bitcoin are actually reachable. So we think Bitcoin fair value should at least be 1.5 to 2.1 million, but we can see higher values. But that would, of course, provide upside to a neutral smart contract platform where a lot of Wall Street will innovate of real world assets.
He is explicitly bullish on Bitcoin. He thinks Bitcoin reaches $1.5 to $2.1 million. And in the same world where Bitcoin does that, Ethereum does proportionately more, because Ethereum is not competing with Bitcoin for the store of value use case. Ethereum is competing with the entire global financial system for the settlement layer use case. Think about what that means in numbers. Gold today is $2 trillion in market cap. Wall Street equities are $40 trillion. That's a 20x difference. Bitcoin today is roughly $2 trillion. Ethereum is roughly $300 to $400 billion. If the same ratio plays out, and Lee believes the structural forces are identical, Ethereum's market cap could end up multiples larger than Bitcoin's. That is not an altcoin prediction. That is a macro thesis built on 50 years of financial history. Here's a question nobody is asking. If Tether, a company with 300 people, is already being valued at $500 billion, and JP Morgan with 330,000 people is valued at $869 billion, what happens to JP Morgan's valuation when AI and blockchain eliminate 310,000 of those jobs? Tom Lee thinks they go from 330,000 employees to 20,000. And he thinks that means JP Morgan has to completely reprice itself as a technology company, not a bank. That is the quiet restructuring of the entire global financial system happening in real time, not in 10 years, now. And the infrastructure it's being rebuilt on? Here's what he said.
I might bookend two companies and then we can put everybody somewhere on the curve, but the two largest banks in the world now are Tether and JP Morgan. And JP Morgan trades at, I believe, over two times tangible book.
Okay.
But they have 330,000 employees, which is their largest expense. And in an AI and blockchain world, they may go down to 20,000 employees. So the JP Morgan likely re-rates in the future towards being a technology stock.
Yeah, no question. This is going to be a little bit like what happened in retail. So Walmart and Costco re-rated as the rest of the industry was being destroyed, right? Or consolidated away, right? That is what we expect to happen. So the other end of the spectrum, so that was JP Morgan.
Yeah. And as you point out, Costco and Tether, Walmart trade at 35 to 50 times forward earnings, which is higher than even NVIDIA's multiple, which I
I know. It's pretty wild.
Now, Tether's tangible book is quite low, and it has a vastly more profitable business because it is very light employee intensive. The employee intensity is low. So if that price to book, let's say, is a exponent, a log function of JP Morgan's 2 to 3 times, which is rising, then that means that crypto treasuries shouldn't trade at 2 times NAV that are involved in the ecosystem. So in other words, the Bitcoin treasuries are designed to be inert. MicroStrategy is an inert holder of Bitcoin, but BitMine is active and engaged in the Ethereum ecosystem. So it'll trade more like a financial intermediary, but JP Morgan and Tether are the bookends. I think that's why that multiple of the ETH holdings will actually rise over time for the winner take most.
Let's connect all 3 dots. Stablecoins just had their ChatGPT moment. They proved that crypto-native financial infrastructure can generate more value per employee than the biggest banks in the world by a factor of several hundred. That wasn't a prediction, that already happened. Tom Lee believes Ethereum is the layer that the entire next generation of finance gets built on, not because it's his favorite project, because it has 100% uptime, it's never been hacked, every major institution is already building on it, and 2025 is the first year regulations have allowed Wall Street to actually move there. And the ETH flip Bitcoin thesis is not a meme. It's a structured historical argument that points to what happened the last time the global monetary system had a comparable moment of structural disruption. So here's the question I want to leave you with. If Tom Lee is right about even half of this, if Ethereum reaches $10,000, $20,000, $30,000, what does that mean for the people who understood this in 2025? And what does it mean for the people who are still debating whether to buy? The window between when something is obviously right and when everyone agrees it's right, that is where the money is made. We saw it with Bitcoin at $1,000. We saw it with Apple at $10. We saw it with Amazon when everyone said it would never make money. Tom Lee just told you where he thinks we are with Ethereum right now. What you do with that is up to you. Subscribe for weekly breakdowns of the conversations that actually matter.
See you in the next